Hey all, welcome to ShareTreck. This is Raj here. Welcome to the fourth episode of our technical analysis course, and I'm going to talk about simple moving average today. As always, we'll keep this short, less than 10 minutes, one concept at a time. Let's get started. This is my spreadsheet. Imagine you're tracking the closing price of a stock over a period of time. A simple moving average smoothens out the price fluctuations by taking average price for a chosen number of periods. Let us say you want a 20-day simple moving average. This means you add the closing price of the last 20 days and divide by 20, and you repeat this calculation every day to get a continuously updating average price. For example, if I was to take you into this cell out here for 20 days, what you would see is that I have average of B2 to B21. So B2 is this day 1 number and B21 is the day 20 number. So I've taken the average of the first 20 days, and that is this one. And when I go to the next one, it's going to be B3 to B22. So now we have moved one step down, and that is B3 is here and B22 is here. So it's a moving window of 20 days, which is giving us every subsequent number out here. These are 20-day moving averages, which is a window of 20 days moving a long timeline. And it takes 20 days before we can get a single reading for the 20-day moving average. Now it's a simple moving average, and if you look at a 6-day simple moving average, you see a window of 6 days. Day 1 to day 6 gives us 49.75. Now you'll ask, Raj, what is this number out here? Where did you get it from? So this is the closing price of a stock. I would like to take a closing price of a stock on any given day and record it here. So if I have the closing day of the stock for 50 days, then I get this entire column out here, day 1 to day 50, one price for each day, which is the closing price of the stock for the given day. From that, I can do a 6-day, 20-day, 30-day, 50-day, 90-day, 100-day moving average, depending on what I want to see. Now the question is, why would I pick up a 20-day, or why would I pick up a 6-day, or why would I pick up a 30-day? Here we are in the TradingView platform, and what you're seeing out here is the chart for Qualcomm. And how I know that? It's because it's written here Qualcomm. It's a 1-day chart, and the reason I know it's a 1-day chart because it's written in 1D here. What it means is that each of this candle is a 1-day candle. We have spoken about that in the very first episode. Now what we are seeing here is the opening and closing prices, and each candle is showing you opening, closing, high and low. And for the whole year, if we look at each day, it's going to be mind-boggling. We can kind of make out a pattern out here, but we'd like to see what it looks like on an average in an easy manner. So this is what we have here. This blue line is a 50-day moving average. Let me convert this 50-day moving average into a 9-day moving average. I'll do that by changing the number of days length here to 9. And immediately you'll see that it goes very close to the price. And that is because there's a very short window of time that is moving around. And if I reduce this to 6-day moving average, you'll see it going even closer to the price because it's a 6-day moving window. So how do we use these things? I'm going to show you another. I'm just going to remove this from here. I'm going to hide the moving average, and I'm going to show you what I use always, which is the moving average, exponential moving average. It's also calculated in a similar format. It's got slightly different formula, but what is important is that it's smoothing out the price. And I'm going to explain to you how to use moving averages. Let us take this set of moving averages where this white line is a 200-day exponential moving average. Yellow line is a 100-day exponential moving average. Blue line is a 50-day exponential moving average. The orange line happens to be the 20-day moving average. And the red line is the 9-day exponential moving average. And it's all set up out here in the chart because we get an opportunity to set it up. We can set the colors. This is the same for any of the platforms that you go into. They allow you to have these charts, and instead of defaults, you can reset the settings, and you can put your own numbers there of how many days you want. Now, let us go into how we use this. In a bullish market, you will always find the longest day moving average to be at the bottom and the shortest day moving average to be at the top. In this case, we have the 200-day exponential moving average at the very bottom, and we have the 9-day exponential moving average at the very top. And the price would be very close to the 9-day exponential moving average. It would be either just above it or just below it. And this characterizes a bullish market. Now, if you move into a bearish market, you will have the 200-day exponential moving average at the very top, and you will have the 9-day exponential moving average at the very bottom. And in between, you have the 100-day, 50-day, and the 20-day exponential moving average a step down each other. So this is what it looks like. And the point of transition is where you get the maximum utility out of moving averages. So if you look at this, if you concentrate on this particular area out here, this is when a bearish market turned into a bullish market. And it is characterized by the 9-day exponential moving average crossing over the 20-day exponential moving average, and then the 50-day, and then the 100-day, and then the 200-day, so that at the very end, 9-day exponential moving average is at the very top. And similarly, if you look at the 20-day exponential moving average, you can see it cross over the 50, the 100, and the 200-day exponential moving average, so that it can also be the second highest in the list. So each of these crossing point where a shorter duration exponential moving average crosses over a longer duration exponential moving average is called a golden cross. So when the golden cross happens, it's a bullish sign. So with every subsequent golden cross happening, the chart is confirming for you that we are moving into a bullish environment. At the end of this transition, when you are into a bullish market, you'll find your shortest duration exponential moving average at the very top and the longest duration exponential moving average at the very bottom. And the opposite of that is possible when you're moving from a bullish environment into a bearish environment. So pay attention to this area. In this area, we can see that there is a transition happening. The market was moving sideways and the 9-day exponential moving average made a lot of golden crosses in this period, but it could not sustain. But somewhere out here, it was able to cross over all the exponential moving average, and we came into a potential bullish scenario out here, but the bull market was not yet complete because the 100-day exponential moving average is not at the very bottom. For that to happen, it had to go through a whole lot of movement. But the reason why I'm showing this to you is that there is going to be transition period where you'll have the 9-day and the 20-day exponential moving average at the very top, but the others are not fallen into the order in which they should be in a bull market. So you would know by that there is still more potential for the market to go up, and it can still go down and get back into a bearish channel. That's what happened out here, and the market became bearish. Again, the exponential moving averages found their own position back again until we came into a situation where there was a definitive transition and the market moved, and we are right now in a bullish channel and we are in a bullish market. It won't take too long for the 9-day exponential moving average to cross over the 20 and then to cross over the 50 and the 100 and the 200. But this gives us a kind of a warning and helps us to prepare for a bear market. When I look at the current situation, I can say that we are in a good position. We are in a bull market. We have not yet gone into a bear market. However, you should remember that all these moving averages are a lagging indicator. They are taking the average of the last 6 days, 20 days, 50 days, and 100 days. And therefore, it will take a long time for the 200-day exponential moving average to respond to any sharp movements that happen in the price right now. So we have to look more or less into the 9-day and the 20-day exponential moving average. And our MACD, which we use, I'm going to add the MACD indicator out here. So the MACD that we use out here has got in it a facility to have two different moving averages to contrast against each other. One is a longer term moving average, one is a shorter term moving average. So we also use MACD to find out if we are moving into a bullish situation or a bearish situation. So I'll talk more about the MACD in a separate video, but right now it's important to understand that simple moving averages and exponential moving averages are lagging indicators. They also perform the roles of resistance and support. When the price is above a moving average, it performs the role of a support. When the price is below a moving average, it performs the role of a resistance. And we have to look at moving averages in conjunction with other indicators like RSI, MACD, the horizontal line of support, volume, momentum, everything. And then we get a good idea or reasonably good idea of what's happening in the market. So this brings me to the end of today's concept. I'll catch up with you again in the next video.